Good morning, afternoon, and evening, everybody. I'm Mike Emiliani, and this is this week's Freight Market Recap powered by FreightRight's TrueFreight Index. Today is January 5th. Let's get started. Global trade policy developments were dominated by tariff shifts and protective measures reflecting the broader geopolitical and economic pressures. India implemented multi-year tariffs on imported steel to defend its domestic industry, while China imposed high tariffs on beef imports to support local producers. The European Union enacted its Carbon Border Adjustment Mechanism, ushering in a new era of climate-linked tariffs that could reshape trade flows for high-carbon goods. Meanwhile, the United States continued to adjust its own tariff regime, delaying some increases but presiding over elevated tariff levels that contributed to a contraction in manufacturing activity. These policy moves occurred against a backdrop of diplomatic efforts and economic analysis. India's economy was noted for resilience despite tariff headwinds, and both India and the EU engaged in talks with major partners to address tariff disputes. The period underscores the continued centrality of tariff policy as a tool of economic and geopolitical strategy entering 2026, with countries balancing protectionist impulses, trade negotiations, and evolving trade framework. We'll move now to this week's air, ocean, and freight markets, starting first with China to U.S. West Coast. Rates saw sharp volatility week over week. Carriers successfully pushed through a short-lived GRI at the end of December, with offers briefly jumping above 3,000 for FEU for early January sailings. However, that increase unraveled almost immediately. Within days, rates were rolled back to roughly $1,000 USD, settling back into the $1,800 to $2,200 per FEU range, with most market activity clustering around $2,000 to $2,100. Promotional rates in the high 1800s reappeared quickly as carriers struggled to secure volume. Now on to China-U.S. East Coast. East Coast pricing followed a similar pattern, though with slightly more insulation. Early January GRIs lifted rates well above prior December levels, but resistance was swift, as was expected with China-U.S. West Coast. As capacity outpaced demand, carriers began pulling rates back, signaling further reductions through mid-January. While US EC remains priced at a premium to the West Coast, the overall trajectory mirrors US West Coast. Brief, GRI-driven spikes followed by rapid erosion. Now moving into the why. Why did this week play out the way that it did? Well, starting first with GRIs met immediate market resistance. Carriers attempted to hold January rates above 3,000, but volumes did not materialize. As noted in the discussion, quote, there will be a zero volume at 3,000, end quote, forcing rapid pullbacks within days. Second big reason is weak fundamentals during a supposed mini peak. Even with Chinese New Year's approaching, this traditionally supportive window failed to generate enough demand. The inability to sustain higher rates during a seasonal inflection point points to just how soft the market remains. Carriers, broadly, cannot afford to leave space unused. Once it became clear that elevated rates were suppressing bookings, pricing discipline collapsed in favor of filling ships. Ongoing geopolitical pressure and uncertainty, largely related to tariffs, are dampening the China export demand. That has been a consistent trend broadly since about April, but it continues to be exacerbated here too. Several shippers have trimmed volumes, reducing carriers' leverage even further. Finally, while some volume has shifted to Southeast Asia over the course of the last couple months to Vietnam, Thailand, Indonesia, those lanes are priced similarly to China, and the lack of scale to materially tighten overall capacity still isn't there yet. Now, looking ahead. In the near term, carriers are likely to accept suboptimal pricing rather than sail with empty space. With January GRIs already fading, rates are expected to hover near current levels or drift lower into mid-January. The inability to hold elevated pricing, even briefly, suggests that any further GRI attempts ahead of Chinese New Year will likely be met with steep resistance. Unless there's an unexpected demand shock or a fundamental change to tariff policy like we could soon see with the Supreme Court and the IEEPA tariffs, the market appears to be set on continued volatility with a downward bias, pushing meaningful rate recovery further into late Q1 at the earliest. Structural overcapacity and muted China export volumes remain the defining constraints as 2026 begins. Shifting gears again now to the China-U.S. air freight market. Air freight rates from China to the U.S., Canada, and Australia declined week over week, as the market continues to work through a post-holiday demand lull. Pricing pressures have been most visible in the spot market, where airlines were offering lower rates to secure volume amid soft bookings from large e-commerce players and delayed project cargo activity. The rate of softness is being reinforced by a notable increase in available capacity at the start of the new year. Additional scheduled lift and the entrance of new charter operators have expanded supply across key lanes, creating more competitive environment and giving shippers increased leverage in near-term pricing discussions. So where does this take us? Well, looking ahead, the current softness is expected to be temporary, at least for the air freight market. Market sentiment suggests rates could begin gradually firming up this weekend or early next week, as factories resume full production and shipping activity ramps up ahead of the pre-Chinese New Year rush. While capacity is likely to remain ample, improving demand should start to absorb excess space, shifting the balance modestly back towards carriers. For now, the spot market remains fluid, but upward pressure is expected to build as we move deeper into January, February, and its respective shipping window. This week, you can find some interesting headlines from the Wall Street Journal, Bloomberg, Guardian, and Reuters. We'll leave all those links in the notes below in the description.